As a reminder, the content shared on this podcast is intended for informational and educational purposes only. It does not constitute personalized financial advice. For guidance tailored to your specific situation, you can schedule an appointment with Carol. This is an independent podcast not affiliated with Money Concepts Capital Corporation. Welcome to She Wins: Women, Wealth, Wisdom, and Legacy, the podcast where financial empowerment meets fearless living. If you're a woman who's built a life with purpose and is ready to align your wealth with what matters most, you're in the right place. Your host, Carol Eddy, is a certified financial planner, financial educator, and passionate advocate for helping women live fearlessly and leave a legacy. Whether they are preparing for retirement, managing an inheritance, or simply looking for trustworthy financial guidance, Carol has helped her clients feel confident in their financial plan for over 25 years. Each week, she'll share insights and practical strategies to help you create financial freedom, navigate smart money choices, master your money mindset, and make winning decisions now and for the next chapter of your life. No intimidation, no overwhelm, no jargon, just wisdom, clarity, and the confidence to manage your wealth, embrace your power, and craft a future you love. Welcome to the show.
Hi, friends. I'm your host, Carol Eddy, and I'm so glad you're here today. Now, let me ask you this. Do you know which account you should pull money from first in retirement? Do you know how to avoid hidden taxes that can quietly drain away your Social Security or raise your Medicare costs? And do you know how to make sure your nest egg lasts as long as you do? If you're like most women I meet, the answer is, I'm not sure, and that's okay. Nobody hands you a playbook for this kind of thing. But here's the truth. It's not about how much you've saved for retirement. It's about how you use it and pull it out. The order you withdraw from your accounts, the timing of those withdrawals, and how you coordinate them with Social Security or Medicare can make the difference between keeping your retirement income steady and losing thousands, sometimes hundreds of thousands of dollars to surprise taxes. So today, we're diving into what I call the hidden tax traps of retirement withdrawals. We'll explore the 5 most common traps that catch women by surprise, real stories of how these traps have impacted people just like you, and then 5 smart strategies to outsmart the IRS and keep more of your hard-earned money. By the end of this episode, you'll have a clear sense of how to avoid the traps, how to order your withdrawals wisely, and how to protect both your lifestyle and your legacy. Part 1, the big mistake. I want to start with a story. A few years ago, I met a woman. We'll call her Evelyn. Evelyn was a teacher for over 30 years. She did everything right. She contributed faithfully to her retirement plan. She didn't spend extravagantly, and she retired with about $1.5 million across a 401k, IRA, and a small brokerage account. When she retired at age 65, she thought, I've saved plenty. I'll just use my money as I need it. So what did she do? She started pulling from her 401k. That was where most of her savings were, so it felt natural. In her first year of retirement, she withdrew about $70,000 for living expenses and some travel. But here's what she didn't realize. Every dollar she took from that 401k was taxable as income, just like her paycheck. And that $70,000 pushed her into a higher tax bracket. It also caused her Social Security to become taxable. And 2 years later, that same income level raised her Medicare premiums. In just her first 3 years of retirement, Evelyn paid more than $80,000 in unnecessary taxes and penalties. Evelyn's mistake wasn't that she overspent. It wasn't that she didn't save enough. Her mistake was not having a withdrawal strategy. And that's the big trap. Many people think retirement planning ends when you stop working, but in reality, retirement planning shifts into a new phase. So now the question becomes, how do I take this money out in the smartest ways possible? Part 2, why withdrawal order matters. Let's make this simple. Imagine all your retirement savings in 3 different buckets. Number 1, the taxable bucket. This money is your savings account, CDs, or a brokerage account. You've already paid taxes on the money you put in, but when you sell investments, you may owe taxes on the gains. Bucket 2 is the tax-deferred bucket. This is your 401k, your traditional IRA, your pension. You didn't pay taxes when you put the money in, but now every dollar you take out is taxable. Uncle Sam has been waiting patiently, and this is when he gets his share. And number 3, third bucket, is a tax-free bucket. This includes Roth IRAs, Roth 401ks, and certain types of insurance. If you follow the rules, this money grows tax-free and comes out tax-free. Now here's where most people go wrong. They look at which bucket is biggest and they pull from that first. It feels natural, but it can create a snowball effect of higher taxes, higher Medicare costs, and even reduced Social Security. The truth is, the order you withdraw from your buckets can 1, change how much tax you pay in any given year, 2, change how much tax you pay over your lifetime, and 3, change how much you are able to leave behind to your family or your favorite causes. Sometimes the smartest move is to take money out of more than one bucket at the same time. Sometimes it's better to pay a little tax now to avoid a lot of tax later. And sometimes waiting to use a tax-free bucket can stretch your money much further. That's what we'll explore today, how to avoid the traps and use those buckets wisely. Part 3, the 5 hidden tax traps. Trap number 1, Social Security taxation. Let's talk about Julie. Julie was thrilled to start Social Security at age 66. She was expecting about $30,000 a year and thought, perfect, this will cover my basics. But when she filed her taxes, she was shocked. Her Social Security had been taxed. Instead of $30,000, she only kept about $24,000. What happened? Julie had also taken out a $20,000 withdrawal from her IRA to help her daughter with a down payment on a house. That extra income pushed her provisional income above the IRS threshold. By the way, provisional income is the income the IRS uses to determine if your Social Security benefits are taxed. As a result, up to 85% of Julie's Social Security was taxable. This is one of the sneakiest traps. Many retirees don't realize Social Security can be taxed at all. But if you combine it with withdrawals from other accounts, the IRS may tax it heavily. Trap number 2, Medicare and IRMAA penalties. So what is IRMAA? It's called IRMAA for short, and it stands for the Income-Related Monthly Adjustment Amount. It's a fancy way of saying if you make more money than a certain amount, then your Medicare premiums go up. I once worked with a couple, let's call them Sam and Linda. They took out $50,000 from their IRA 1 year to buy a vacation condo. 2 years later, they got a letter. Their Medicare premiums were going to go up by $200 per month each. That's nearly $5,000 more per year. Why? Because Medicare looks at your income from 2 years prior. One big withdrawal can echo into the future and cost you thousands. Trap number 3, required minimum distributions. Starting at age 73, the IRS says you must begin withdrawing from your tax-deferred accounts. These are called required minimum distributions, or RMDs. Let's go back to Evelyn. She left her IRA untouched, thinking, I'll save it for later. By 73, her account had grown significantly. Suddenly, she was forced to take out over $80,000 per year, whether she needed it or not, and every dollar was taxable. This created a tax time bomb. Trap number 4, double tax on capital gains. Imagine this. You sell $50,000 worth of stock to help a child with a home to purchase. That sale triggers $10,000 in capital gains tax. But here's the kicker. That extra income also pushes your Social Security into a taxable range that bumps your Medicare premiums. It's like a domino effect. One decision can cascade into multiple taxes. Trap number 5, the widow's penalty. Finally, the one that breaks my heart most often. Martin and Diane were married for 40 years. Together, they planned the withdrawals carefully. But when Martin passed away, Diane was shocked to find their taxes went up, even though her income stayed the same. Why? Because as a widow, Diane was taxed as a single person. The brackets were smaller, and the same $80,000 worth of income cost her thousands more in taxes. And women are especially at risk because we tend to live longer. Without planning, this penalty can take a big bite out of the surviving spouse's income. Part 4. 5 strategies to outsmart the IRS. The good news? You don't have to fall into these traps. Strategy number 1, fill the bracket. Instead of avoiding taxes completely, take just enough from your IRA to fill up the lower tax brackets each year. It's like paying 12% today to avoid paying 25% later. Strategy number 2, Roth conversions. You can gradually move money from your IRA to a Roth IRA. In a Roth, you pay the tax now and the money grows and comes out tax-free forever. And Roths don't have required minimum distributions like a traditional IRA. Strategy number 3, tax diversification. Don't pull from just one bucket. Spread withdrawals across taxable, tax-deferred, and tax-free accounts to smooth your income and keep taxes lower. Strategy number 4, coordinate with Social Security. Sometimes it's smart to draw from your IRA earlier while delaying Social Security. That way, your Social Security check grows and your future required minimum distributions shrink. Strategy number 5, charitable giving smarts. If you're charitably inclined, give directly from your IRA once you turn 70 and a half. These qualified charitable distributions don't count as income, lowering your taxes while supporting the causes you love. Part 5, a real-life example. So let's put all this together. Imagine you're 65 with $800,000 in a 401k, $200,000 in a Roth IRA, and $100,000 in a brokerage account. In scenario A, you pull only from the 401k account. Your income tax spikes, taxes are high, Social Security gets taxed, and Medicare premiums go up. Scenario B, you use the brokerage account first, do small Roth conversions each year, and delay Social Security until 70. By then, your benefit is higher, your RMDs are lower, and your lifetime taxes are dramatically reduced. In fact, over 20 years, Scenario B could save you hundreds of thousands in taxes and leave you more to your heirs. So here's the takeaway. Retirement planning doesn't stop when you leave work. In many ways, it just shifts gears. It's not just how much you save, it's how you spend it. The hidden traps are real. Social Security taxation, Medicare penalties, RMDs, double taxation, the widow's penalty. But with the right strategies, filling the bracket, Roth conversions, diversification, timing Social Security wisely, and using charitable tools, you can outsmart the IRS and protect your retirement. To help you, I've created a free guide, the Retirement Withdrawal Checklist. You can download it from the link in the show notes. It walks you step by step through the order of withdrawals so you can avoid traps and keep more of your money. And if you found today's episode helpful, please share it with a friend. So many women don't realize how much money can slip away in taxes. And one share could literally change someone's retirement. Until next time, I'm Carol Eddy, reminding you, you work too hard for your money to let hidden taxes take it away. Thanks for listening.
Thank you for joining us today for the She Wins Women, Wealth, Wisdom, and Legacy podcast. If today's episode sparked a shift in how you think about your money, your future, or your legacy, imagine what's possible when we walk this journey together. And if you found value in today's conversation, please share this episode with a woman you care about. Together, we rise and we win. If this inspired you to take charge of your financial future, don't stop there. Download your free guide, A Woman's Guide to Triumph in Every Decade of Her Wealth, by clicking the link on the screen or in the show notes. It's designed to give you powerful tools and clarity at every stage of your wealth journey. And be sure to follow or subscribe now so you never miss an episode. Until next time, stay wise, stay empowered, and remember, it's time to rise, lead, and thrive with your wealth, your wisdom, and your legacy. As a reminder, the content shared on this podcast is intended for informational and educational purposes only. It does not constitute personalized financial advice. For guidance tailored to your specific situation, you can schedule an appointment with Carol. This is an independent podcast not affiliated with Money Concepts Capital Corporation.